Hello, everyone. Good evening and welcome to the Momentum Lab channel. This week's video, we have a different topic. We're actually we've received a lot of comments, queries, etc. on this topic, right, Shekhar? So
Yeah,
we will be discussing ETFs. So can you just give us a brief about, what we are going to discuss and how it's going to be this week?
sure, definitely, Geeta. So I think we have received a lot of comments from our subscribers asking us to focus more on other factors also, not just momentum, and give more light on value, alpha, quality, growth, low volatility, etc. So we try to do that. Just like any other uh, mutual fund or small case video, we have tried to list down all the possible ETFs that are there in the Nifty NSE index and come up with the best ETFs based on a couple of criteria. One being the returns, and second being the Sharpe ratio. And also, we've looked at different time periods. One since inception, so that is from 2005 onwards. So that itself takes 20 years of data, meaning three cycles. If we take at least 7 to 8 years as one cycle, that covers a lot of cycles, at least three cycles of data. And also, we've seen last 5 years to give the perspective of what was happening in the last 5 years. And then we have come up with the final list of the ETFs that have performed on all of these parameters across the time zones. And the results might not be surprising. And most of them are in momentum related ETFs.
Category. Yeah.
Uh,
I mean, I don't know, maybe some people may have the question, like, are we biased towards momentum? Why is, only momentum being focused on? Like we do small cases, we do, mutual funds, etc. In fact, our whole channel itself, Momentum Lab, is focused on momentum. So I think
right.
towards the end, when we see the results, which were as surprising to us, in fact, right? When we started out,
Yeah.
we thought that, let's check it out because it's a new field, we're analyzing a lot of things. We were also pretty shocked that momentum has come up a lot many more times than the other factors have come up.
Yeah, I think when we see the entire video at the end, many will have their doubts cleared that momentum does well on both the counts, the returns as well as the risk adjusted returns, meaning the returns that we expect for the risk that we take are well commensurated, and we're getting the bang for the buck, in other words.
True, true. And this is a new video, new format that we're trying actually for the first time, where we're trying to keep it more conversational. Because, these are the questions that we'd ask each other if we're making a video, or, these are some of the things that we tackle. So we sort of try to keep it conversational and casual. Again, before we get into the video, I'd like to say that we both are not SEBI registered advisors, and all of this content that we're sharing here currently today is only for educational purposes, and it's not to be treated as financial advice. Please, you can gather the educational content from here, meet with your own financial advisor, and take decisions if you're actually putting in your money, etc. So, hope you enjoy this video, and this video is about ETFs in detail. And
ETFs.
let's check it
Yeah.
out. Yeah, so this is the NSE website. Shekhar, can you just take us through like what is it's a wonderfully looking wheel and all of that?
Sure, definitely. So as you can see, there are a lot of variations of ETFs or indices offered by NSE. On the blue colored pie chart, you can see these are all fixed income or debt related indices, and the orange colored ones are related to equity. Now we'll be focusing purely on the equity. Now within equity, there are different kinds of indices or ETFs offered or indices offered by the NSE. Broadly, there are four major ones. The first one is market cap. Now, for example, Nifty 50, Nifty Next 50, Nifty 200, small cap, mid cap, and Nifty 750. These are the different types of market caps. So, any investor can build their portfolios or can invest in mutual funds or ETFs based on these indices. And then these indices are also used by a lot of active managers to compare and benchmark their performances. So that is one broad market cap indices. Then we have two different types of indices called as sectoral and thematic. Sectoral, as the name says, for example, you might have indices which track or which closely mimic the sectors. For example, auto might be one sector, CNX auto, or there can be indices which track IT, FMCG, pharma, etc. And then there are certain thematic indices. Thematic indices are essentially cross function of different sectors. Maybe let's say if you have Nifty MNC, then in that index, you might pick stocks from different sectors, but which are listed as MNCs. Maybe you have Siemens, you also have Abbott, and you also have Bosch. Even though all of them are from different sectors, but they come under one theme called as Nifty MNC. And there are also different themes like Nifty Sharaya, and you also have group-based indices like Mahindra Group, Tata Group, etc. Now, there is a challenge when someone uh, tracks or invests in sectoral or thematic. Let me highlight that first. So, investing in a sectoral or thematic index carries a lot of risk because you'll need to be adept at identifying the business cycles, and the volatility in sectoral indices is pretty high. So maybe if someone is really good at timing the sectors, maybe based on valuation, based on momentum, or whatever parameters that you choose, and if you are good at timing, then following a sectoral indices might be helpful. But if
That's,
someone,
I think, sorry for interrupting. I was
sure,
thinking
sure,
either for sectoral or thematic, etc. It'll be nice if, we construct a portfolio from it. So
right, yeah.
someone wants to look at, one ETF, or they have a bandwidth for two, or, they just want one of it as to be a part of their major portfolio, then I think both sectoral and thematic might not really do the job. I'm just adding to your point.
Yeah, absolutely. A portfolio kind of an approach might work in sectoral or thematic ETFs than blindly following any single ETF, unless you are an expert in timing and predicting the business cycles. Whereas in strategy, the advantage is that all the strategy factors or all the strategy indices are based on certain factors. Now, it could be single factor or it can be a combination of factors. Now, factors are nothing but you can understand them as the key drivers in any stock's performance. Now, if you're able to attribute the key driver in a stock, maybe to its momentum or its quality or its value, value can be represented as price to book. Quality can be represented by its profitability margins, and you can also have growth related factors. And anyhow, momentum, and there are also low volatility, and
Yeah,
there is value.
volatility especially. Sometimes I think there are multi-factors, right? Like we've also seen a lot
Yeah.
of factors overlap with each other, and the new kind of factors emerge.
Yeah, and these factors have a solid academic backing, where these factors have shown to be performing well across market cycles, and they have a better risk-adjusted returns in terms of Sharpe ratio. So these factors are purely based on rules, and since they're purely based on rules and they offer an alpha or excess returns over and above the index, they are beautifully positioned between an active fund and a passive fund. In an active fund, you might be getting an alpha because of the fund manager's expertise, but that comes with a high expense ratio. Or you can choose another way, that is invest in passive funds, which are just mimicking the indices by investing in index mutual funds or ETFs. Now, the advantage with passive funds is that you get same returns or similar returns as the index, but you get it at a lower expense ratio. Now, quant or factor based strategies sit in between. They give you an alpha, which active funds provide. At the same time, they come with a very low cost. So that's the sweet spot of having a factor based or strategy funds. So, Gita, let's look at the different kind of indices or strategies which NSE offers.
Absolutely. In fact, before going there, I just want to add another point here. We keep discussing this also in the mutual funds video, etc. That passive funds have another advantage where there's a lot of transparency in the kind of stocks that are bought and sold, right? So because they're mimicking an index, you can easily do it yourself as well if you have the time and you want to do the research, etc. So here again, we are back with the indices. Let me just double click on the strategies to show you what all exists. So some of the things that are listed here are Nifty Quality 30, Nifty Low Volatility 50, Alpha 50, Nifty 100 equal weights, etc. In fact, when we click on more, we'll see that there's a list of strategies. In fact, there's a lot of indices, strategy indices that are available to us. There are 39 of them. And we
Okay.
have detailed out all of that for you here so that you don't have to, look for it. What we have done in this detailed list, is that we have identified the index that is there. We have identified two major data points. One is for 5 years time period, and one is for since inception of that
Right.
particular index. So even in the if for both these data points, we have again double clicked into three data points each. So we're looking at the returns, we're looking at standard deviation and Sharpe ratios. So Sharpe ratios are nothing but simply understood returns by the standard deviation, or the returns that you get, the excess returns you get for the risk you take. So these are a few things that we have identified over here. Shekhar, will you like to take them through the next steps?
Yeah. So standard deviation is nothing but a proxy to volatility. So if you have a higher return with a lower standard deviation, that's an ideal scenario. So out of these 39 indices that are being offered by NSE, we see that some of them are pure factors like momentum, pure quality, pure value, pure growth. Then there are certain combinations of value plus growth, momentum plus quality, momentum plus low volatility, etc.
Yeah.
Have an ETF offered by the institutions. Only some indices are offering ETFs. But what we have done is we have taken all the indices and compared their returns and standard deviations across 5 years and since inception, and identified the top 10 ETFs, so that at least if you are aware of what indices are performing well, at least in future, if there's an ETF that any institution offers, then we are ready to lap it up and invest. So let's look at the next tab, which focuses purely on returns. So we have done this analysis on two ways. Either you can optimize for purely returns, or you can optimize for Sharpe ratio, keeping in mind that just by optimizing Sharpe ratio is not sufficient. We'll optimize for Sharpe ratio and also ensure that the returns are above the Nifty 50 benchmark. So
Yeah,
in both,
Shekhar,
you see
sorry
that.
to interrupt you here. One point that I'd like to tell our viewers is, we have also divided these data points into two things, right? So one, this is for the inception part. So we're looking at returns and Sharpe ratios here for the since inception. So
Inception,
those are
yeah.
the numbers. Yeah, yeah.
Since inception, because that covers a long cycle. Since inception means any of these ETFs or indices, the data is provided from 2005 onwards. And 5 years is a very recent data, but 5 years is a good data to take a call on. But if you have 20 years of data, then you have seen at least two or three cycles. And if you have seen two or three cycles and the returns and standard deviation are spread across these cycles, then it is a good indication or proxy that these can hold good in future also. So let's look at both the inception data as well as 5 years data and see, are there any changes, or are we seeing same kind of patterns? So if you see the inception data, you can see that we have sorted by purely on the returns.
Yeah, these are for the returns, and
Right?
we've also
These are the
included the
returns.
Nifty 50 over here benchmarks.
Correct. Yeah. So you
So
can see that these top 10 that you find, you will see that all of these returns are above the Nifty 50, and we are not taking into consideration the Sharpe ratio, purely on returns. Now, on the returns, you can see that there is a trend emerging of what kind of indices are coming up more frequently. Pure momentum is coming up three times. You see that Nifty mid cap 150 momentum 50 stands on the top. Nifty 500 momentum 50 stands second, and then there is Nifty 200 momentum 30, which stands at rank 7. Now
that's
there are also a combination of momentum plus other factors like momentum plus quality. That again comes two times. So if you see out of 10, five indices are dominated by momentum and momentum allied ETFs. So that's where even our emphasis comes, that momentum works in long cycles and does deliver pretty good returns. Gita, any other insight that you can draw from here?
Yeah, so another thing that we have seen, like perhaps when we look at the other sheets as well, we can see that uh, a combination of factors is always working, Shekhar. That's what I've realized.
Hmm.
So while in this one we can see that pure momentum has also given a pretty good number of times it has represented, but I think a combination of factors has always worked. We'll
Yeah,
probably
maybe I think when you see the inception Sharpe, I think that will come out. your
Yeah,
point.
absolutely, absolutely. And like Shekhar was saying, so why do so some of these indices don't have ETFs available at the moment yet. But the idea to identify this particular index based on all of these is that perhaps next year or sometime in the near future we may have an ETF. So we have a ready list, ready say
Right.
this is some index that we should look out for. Like it's in a watch list.
Correct. Correct.
Yeah.
Yeah, it's a definitely on a watch list. At least the Nifty mid cap 150, momentum 50.
Absolutely. In fact, one thing is that it surprised both of us to see so many ETFs of the
Momentum.
momentum category.
Yeah.
It felt like it felt very energizing that in momentum and quality came up so many times.
Right.
Yeah.
I think that one surprising thing is that value doesn't come out strongly in Indian markets. And I don't know about the international markets. We'll have to see whether value has worked or not. But at least none of the value-based factors have featured in the top 10 in both Sharpe ratio as well as in the return terms.
Yeah, even in Sharpe, I think we Sharpe ratio we have one value, but that's really not a great representation. Like you were saying in the West, the markets I think they're all over value, but over here we're still sort of looking at other strategies as well. Yeah, so this is for the since inception Sharpe ratio, Shikhar.
Sorted by Sharpe ratio. Got it.
Yeah, absolutely.
Again, these momentum come on top. Nifty mid cap 150,
Hmm.
momentum quality, final momentum 50. These are all momentum based. So that's a misconception many people have, that momentum is a very risky strategy. But as you can see, if you are trying to optimize by just looking at returns, you will see momentum coming on top. If you want to optimize by the Sharpe ratio, even then momentum comes on top, because momentum gives better returns for the risk that you're taking. So you get more bang for the buck in both returns as well as in Sharpe returns.
Absolutely. So, shall I take us through the 5 years returns and Sharpe ratios?
Yeah.
Okay. Uh, so this is with respect to the returns based just on the 5 years period. Again, you will see the results are pretty similar in the sense that momentum is topping, pure momentum is topping with sort of two
Hmm.
indices there, and again we have momentum plus quality coming at two. So I think in the 5 years, so in the recent times, we are seeing that alpha and value as individual indices are also sole indices are also coming up. So we have
Yeah,
two.
I think alpha is also a similar, in fact, a similar kind of a factor for momentum, because you get an alpha only when the stock is overperforming the index. So loosely, we can term alpha also similar to the momentum factor.
They're very closely related if you want to look at it from that sense.
Yeah.
And yeah, we are having value and quality. So in the last 5 years, I think we are seeing a little more of individual in the indices throwing up as well. And when we take
Mhm.
the 5 year Sharpe ratio again, momentum and momentum plus quality is there. And there are much
Mhm.
more number of alphas over here. Like pure alpha, we are having two of them, Nifty 200 Alpha 30, and we also have Nifty Alpha 50, and then there's also low volatility alpha plus low volatility coming up. Then
Mhm.
quality has been really less. Like we saw one or two in quality in all of these things.
Right. I mean, if
So
you look at the Nifty mid cap 150, momentum 50, it gives a Sharpe ratio of 1.73 with a returns of 38.7. That is phenomenal. But unfortunately, we don't have any ETFs, right, for this?
no, at the moment not. I think when there's ETF release, we grab it. So yeah,
Hmm.
there's unfortunately no particular ETF available for us at the moment.
Are
When
there any
yeah,
common ETFs that you find, or common indices that you find for both 5 years as well as since inception, plus returns and Sharpe ratio, like one final
yes,
list?
yes. We have put together one final list. These are so the top table is a top ETF list for since inception, and this is based on both returns and Sharpe ratios. So it's what are overlapping, the indices that are overlapping, and here
Got it.
down below is for 5 year period. So Shekhar, any insights from your end about these two tables?
So the green ones are the ones which are overlapping between 5 years and since inception, right?
Yes.
So then these four are the indices which are featuring on all parameters. That is, they are really good at pure returns. They're also good at the Sharpe ratio, meaning risk-adjusted returns, and they're also good at different time frames, last 5 years and since inception. Those four are Nifty Midcap 150 Momentum 50, Nifty 500 Momentum 50, Nifty Small Cap 250 Momentum Quality 100, and then Nifty Mid Small Cap 400 Momentum Quality. These are basically momentum and momentum allied factors. So
In
and
fact,
hence our
sorry.
strong focus on purely on momentum as a factor, because that seemed to work in Indian market from uh, quite a period of time, at least last 20 years. And we also see that it has a really good a Sharpe ratio. Are there any ETFs offering among these four, Gita?
Yeah, we do have them. In fact, momentum and quality together, we have Mirai Asset Mutual Fund is offering in both the categories at the moment. We have
The
Mirai. Yeah, sorry.
Nifty Mid Small Cap 400, if you remember, we saw a research paper done by Rajan Raju where he has shown that this particular index offers a better momentum. So, do we have that research paper ready, or so that we can just
Uh,
show?
I will just link it
But
in the description, I think.
yeah,
At the moment, I'm not entirely sure we can have it. Just give me 1 minute.
yeah, no, I think we have covered this in our previous videos. So, if
Yeah,
someone
that's
is
true. You
interested,
have a video
that
on, which sort of large mid cap, small cap,
correct.
which is the sort of choice to take. If people,
Yeah.
for interested subscribers, I'll be linking that video also in the description. You can please take a look at it. Yeah.
Yeah, I think Nifty Mid Small Cap 400 was the best universe when we consider momentum as a strategy, and that has been proven by Rajan Raju. Is a great academician who works purely on the factors and factor related research activity. And we also see that the same thing is coming up in the indices research also, that Nifty Mid Small Cap 400 momentum. The additional thing is they've also added quality 100. I think the way how these indices are structured is that they take the mid small cap 400 index and they calculate momentum based on the last 12-month returns, excluding the last 1 year, 1 month, I believe, or they take the last 12-month returns. We can click on that and we'll see
Yeah.
how are the.
Just going there,
I
I'm
think it's
one of the momentum ones. So when you directly click over here, you'll also be taken to this page where you can find a methodology. Let's just quickly look at it.
right.
That's a long,
You can come down in the strategy indices, maybe they're directly available.
long list of stuff. But yeah, here we
Yeah, in fact, NSE maintains a very robust list of all the different types of indices. I think you can click on the top. This is the if you
This is the
scroll,
Nifty 200 momentum 30.
see this. I think so. This is the way they are constructing. So they take 1 second. So they take the top 6 month. Can you scroll little bit up?
Yeah,
I
yeah.
just showed the technology. So if you scroll a little bit up, so yeah, so they calculate the momentum score for each company based on its last 6 month and 12-month price return adjusted for volatility, meaning they are taking returns by risk for past 6 and 12 month, and then they're getting the scores of these companies. Then they are calculating a quality score for each company based on the return on equity, the debt to equity ratio, and the EPS growth over the past 5 years. Now, then they give equal weightage to both momentum factor plus the quality score, and then sort the list of stocks among these top 400. And that's how they pick. I think they're also doing one more classification. They pick 50 specifically from mid cap and 50 specifically from small cap, so that there is equal representation from both mid cap and small cap. I think that's the structure that they are following to calculate this index.
And if our subscribers are interested in looking at how each of these indices are constructed, you can directly go from this list and click on the thing and the methodology. You can absolutely understand how it's done, and you can also see the constituents of each index. So if you want to replicate it yourself or some other thing, that can also be done. So NSE has like a lot of information.
Yeah, I mean, when we say replicate, not the exact stocks, but we meant to replicate the kind of strategy that you want to emulate. You can use the methodology which is openly shared by NSE. And I think you can also see that they have a very good website or a screener called.
Yeah, we do have
Yep.
this India passive funds. So once you identify the ETF, etc., if you want to know about, how the fund is doing, etc., you don't have to individually go to the fund house to look at it. So you put in a couple of filters over here. You say, let's say the underlying index is Nifty 50, and then the fund house that's offering is ICICI, and then you just apply your filters. You'll be getting all of your things. So even over here, you understand the details, and there's a lot of details that is available on indiapassivefunds.com.
I think this is a really cool website which is being offered by NSE. I mean, we don't have to visit any other screeners per se, and we can solely rely on the website, official website of India NSE. I think it is called as indiapassivefunds.com. We'll anyhow share that link in our description. I think we've tried to summarize our most important takeaways from this video. So we have seen that in ETFs, we are focusing purely on strategy indices. Broad-based indices are also good, but they just mimic the index, whereas strategy indices offer an alpha over and above the broad indices. So that's the reason we've chosen strategy. Within strategy, we have taken optimized results based on return as well as Sharpe ratio for two different periods since last 5 years and since inception. And we have found that on all of these cases, momentum scores really well, and a combination of momentum plus quality also does well. So the top 4 slots among the top 10 or top 5 slots among the top 10 are occupied by momentum and momentum quality. And we've also seen what are the ETFs or institutions which are offering these ETFs. We find that Mira Asset at this point of time is the major institution which is offering ETFs for these indices. And we also see that the tracking error is pretty low, around 0.32, 0.31, even though the liquidity is small. But as time progresses, once there is enough liquidity, then we might see that even the tracking error might diminish even further. And also to be noted that the expense ratio is also pretty small, around 0.3, 0.35 percentage ranges. So that's the advantage. You get best of both worlds. Like you mentioned, you get passive funds kind of load or expense ratio, and you get an alpha which is over and above the benchmark indices, which is similar to the actively managed funds. So that's the recommendation, guys. And we'll share this list, the Excel sheet links that we prepared in the description. Maybe it will be helpful for you guys. Have a nice day.
Yeah.
Geeta, anything to add?
No. Actually, I think one thing is that we had a lot of fun doing this video, and just when momentum throws up like that, it just makes us happier a little bit. So that's about it, guys.
Exactly.
Yeah.
Yeah, I think our bias for momentum is now justified, because it's not that we like momentum, but we see that the data also suggests that momentum is a well-known factor in India, and the consistency is there.
That's true. Thank you once again. Thank you for joining with us. And we've also tried something new over here, a conversational style video. Please do let us know if you like such kind, or if there's any other questions regarding the content itself. We'll be linking all the important links in the description for you, so you can be able to you'll be able to access it. Thank you once again. Thanks, Shekhar.
Thanks. Bye.